This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
Charlie's been covering it. We've been covering it, watching the trading in those 11 spot Bitcoin ETFs that were approved by the SEC after the close yesterday. An interesting story just crossing, though, having to do with Vanguard's offering, and this on a day where we saw Bitcoin moving in a big way to the upside, surging past 49,000 for the first time since December of 2021, but it's moved off of that, so we've seen a fair amount of volatility, Tim.
Yeah, that story, Vanguard's brokerage arm will not offer trading in ETFs that invest directly in Bitcoin. That's according to a spokesperson. This story just crossing by our own Paige Smith and Catherine Doherty. Well, tracking all the ins and outs and curves along the long and winding road to a spot Bitcoin ETF is Bloomberg Intelligence senior ETF analyst Eric Balchunas. He joins us on Zoom from New York City. Also on it is Bloomberg News cross-asset reporter Emily Graffeo. She's here in our Bloomberg Interactive Brokers studio. Emily, let's start with you. I just want to talk about how these 11 ETFs are trading.
Or not trading in the case of Vanguard.
Well, that's...
Sorry.
Well, but that makes sense. I mean, what do we know about fund flows into them? Can we make any conclusions on the first day?
The conclusion on the first day that we can make is that this is a historic day for ETFs. This is likely to be, for the Grayscale Bitcoin Trust, ticker GBTC, it might be the largest or the second largest first day of trading for an ETF ever. Right now, we have about $2 billion of shares exchanging hands. The total for these 11 funds in total is about $4.2 billion. So these are massive moves.
That's what Eric Balchunas put out, that there might be $4 billion or so, right, in the first day.
Of the total volume traded for all of these ETFs. So, and maybe Eric will dive into this, Grayscale Bitcoin Trust, it has already existed since 2013. So this was converted into an ETF.
Yeah, go to any airport and you'll see an ad for it.
Exactly, yeah, I know. It's crazy, everywhere.
Right?
But at least for the first day of trading as an ETF, it is topping these records. And even the funds that are beginning trading today and were not converted from a trust, look at the iShares Bitcoin Trust, ticker IBIT, that's seeing almost $1 billion. Right now, it's about $999 million.
Was the uptick, though, right out of the gate? Because it feels like it's been,
so the value, the trading volume has pretty much been picking up all day. I've been staring at the volume all day, and it's just steadily climbing. We're now at 4.2. In the first 2 hours, I think it was about $2 billion. So it's been pretty consistent all day of this trading activity.
Eric, come on in. Would you consider this a success in the first day of trading?
Oh, yeah. I mean, this obliterates all the records pretty much. IBIT alone will break BITO's first day. Mm-hmm. Now, there is some complication because there was a couple ESG ETFs that BlackRock put out where it had one giant institution come in at $2 billion. And so that one creation made for volume of $2 billion. So it's a little complicated, but let's just say this. BITO, which was one of the most successful launches, IBIT is going to trade more than that. Looks like IBIT's going to finish at about 1.2 billion. The whole group of them, 2.2 billion. Now, GBTC, I don't really count. It does count towards the story, but it's not a fresh new ETF. And when you think about a fresh ETF, and I've been doing this a while, I call it the ETF Terradome. Going into the ETF world with nothing is like a newborn being like shoved into the Amazon jungle. All right. GBTC came with all this volume. It's been around, like you said, it's advertised on airports. The rest came in as newborns. So this is like comparing a grown person with a newborn, in my opinion. And I'm going to stick to the newborns that I will include GBTC because the fact that it traded $2 billion is alone massive. And get this, BITO has traded almost $2 billion, which will be a record day for it. And it's not even part of this race, really.
Well, speaking of the newborns, let's say there are 10 newborns out there, Eric. Not all newborns, at least as when it comes to trading volume, were created equally. I mean, it looks like there are some haves and have-nots when it comes to activity right now. Should we read into that?
Sure. Well, I'm definitely reading into it. I mean, this is basically a horse race. We've never had a bunch of ETFs lined up to launch on the same day, hence the Cointucky Derby phrasing we're using for this, and the horse race memes, which I've been drawing up all day instead of working. So if you look at BlackRock, they're going to be like a lead horse. And then next you got Fidelity, then you got ARK-B, all them, and Bitwise, all them over 100 million. That's a monster success. So you have 4 that I would call smash hits by any measure. Then you go the second half a little less. Franklin, 64 million, pretty good. Hodl, 24, but we'll call those like, back of the pack. And then there's a couple below 10 million. And so just as I figured, at the end of the day, there's going to be one GLD stud liquidity, probably the BlackRock one. Then there's going to be like upper middle class. Then there'll be a middle class. Then there'll be like 1 or 2 poor people who just didn't ever get it going. And ultimately, you will see some liquidations. So that's how it goes in any category. And it will probably go that way here.
Whoever said the investment world was fair. What's really funny
You got to ask which one's Seabiscuit.
I'm just going to say, and Eric is amazing, but you definitely need to get sleep this weekend. All right, so Emily, come on in, because I do wonder if they're not all going to be the strongest players or get the most volume or activity or attract the most investors. Should we assume that there's going to have to be some consolidation later on, that a couple of funds are just not going to make it?
Yeah, I think there are some expectations. I was speaking with Athanasios Serafagis, who works with Eric, and he said that he might expect some of these to close, but we really have to see. And I think it's interesting because this is just the first day of trading. So like you had mentioned at the top of the hour, there are some brokerages that a lot of retail investors use, like Vanguard, like Merrill, where you can't even buy the funds yet, maybe not. Maybe you'll never be able to. We'll have to see if they change that rule. But this was really just, the institutional trading. So we could see more organic flows coming in the weeks, in the months ahead, when these funds are actually added to more broker dealers. I actually spoke to one financial advisor today who said, I want to buy this. I can't yet. It's not on my platform yet. But when it is added, I will be buying it. And then, of course, the actual flows we won't be able to see until at least tomorrow or beyond that.
So is the price of these funds, forgive me if I sound kind of stupid, but is it related to the price of Bitcoin? Is it related to the demand of the funds? Like, what is really driving the trade? Eric, let me throw that to you first. Like, what is it?
Yeah, so I think for advisors and people who are not like hardcore crypto people, they think this is a mission. All right, that's a whole different mindset. Everyone else thinks this is a little hot sauce to put on an otherwise boring portfolio, 60-40, low cost. It's a beautiful thing, but they got to wait 30 years as these things compound. Compounding returns is the magic that we're all here for. But that's boring. You got to wait 30 years. So there's, I think, a growing hot sauce bucket in every portfolio. This is where Cathie Wood lives. Cathie Wood and Bitcoin have a lot in common.
Yeah.
This is what if they're right? And I don't want to kick myself in 10 years. That is what is going to get people to make a small allocation to this, even if they don't really understand it.
But just to confirm, Eric, it tracks the price of Bitcoin, and the price that we see has nothing to do with people buying or selling it. It has to do with the price of Bitcoin, right?
Well, yeah, they're intertwined. I mean, the price of Bitcoin moves as it does. Now the ETFs will be a player in the price of Bitcoin, because if they get flows, that's a 1-for-1 buy for Bitcoin. Okay. So flows equal buy Bitcoin. Outflows equal sell Bitcoin. But there's many other things that are buying and selling Bitcoin. So if the ETFs make up, say, 2-3% of the Bitcoin market, that would be like around what it is for gold.
Last question, Emily, 25 seconds. So now what? Like, what do you, as someone who watches this, have to focus on?
I really want to see the flows. Maybe we'll get some tomorrow, depending on when these trades settle. But this is the trading volume that we got today. Tomorrow, we'll be able to start seeing which funds actually had net inflows, because trading volume doesn't tell you if it's buy or sell.
And is there a difference between kind of what the funds were kind of already planning to kind of have for the fund versus like kind of new organic interest, right? Will we get that distinction?
We'll see that. We'll see those net inflows or outflows tomorrow. Because like Grayscale Bitcoin Trust, there's a lot of trading volume. Might be some selling in there too.
You guys are amazing in the coverage. Bloomberg Intelligence Senior ETF Analyst Eric Balchunas, and of course Bloomberg News cross-asset reporter Emily Graffeo. Thank you guys.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Now you're throwing it all away. Now it cuts like a knife.
All right, so you know the news. I I was listening in at 8:30. I stop everything. I'm out of my shower. I'm like, I got to listen to Mike McKee breaking down the CPI report.
Wait, what time was this? How did you get here so? Tell me what the timeline here.
I think I was done, and I was like walking out.
Okay,
the door.
because you were got here before I did, and I listened to Mike McKee on my
But I was walking out the door, and I'm like, I had to stop.
Did you take a helicopter here,
walking
Carol?
in a towel.
Don't go there. Well, speaking of that, a hotter than anticipated inflation data tempered market bets on a Fed rate cut in March. Let's get to it. Let's get to the breakdown. Michael McKee is with us. He's Bloomberg News International Economics and Policy Correspondent here in studio. Also with us, lucky for us, is Yelena Shulyatyeva, Senior U.S. Economist at BNP Paribas. Mike, as I said, in studio. Yelena over at BNP's offices in New York City. Welcome, welcome, welcome. So, Mike, it sounds like hotter than expected, but I feel like it's not terrible. Is it a major rethink for all of us?
No.
Okay.
It's not. It was something of a rethink for futures traders, but not for anybody who'd been sort of paying attention, because it was expected that we would see headline go up. It went up a tenth more than the consensus for the month, but the core was right on at 0.3, and then the core year over year went down as forecast. So there's still some progress there. There were some areas that were a little bit of a surprise. Used cars went up, and they've been going down, and there was an expectation they would still be going down. Gasoline prices went up a little bit during the month, something you didn't think about. And then insurance, medical and especially auto insurance have gotten more expensive, and that just doesn't seem to stop. And it's very interesting with this Tesla story today in Hertz, because the idea is that, as I understand it, that cars are getting more complex because of the computers and stuff, and so insurance companies are raising rates because they feel they may have to pay more.
Interesting, right?
Yeah, that is. The areas of stickiness were really interesting. Hey, Mike, I kind of want to go off script and get your take on a redhead that's crossing the Bloomberg terminal right now. We're hearing from Christine Lagarde, who's speaking in an interview on French television, that rate cuts can start once data confirm an inflation path, and that the rate cuts, can't give a date for ECB rate cuts, though the ECB is likely at peak rates. Any surprises there?
No, it's basically, I think the various central banks are passing around a song sheet, and they're all
I was going to say, it doesn't sound too different than what I've heard from other central banks.
It's the idea that the inflation path down to the target of 2% is exactly what Loretta Mester told us today, what Jay Powell's been saying, what John Williams said yesterday. That there's nothing really new there, and can't give a date for ECB rate cuts. Why would you want to do that?
I want to mention another headline from her, because she says history suggests a Donald Trump victory would be a threat, and that under a President Trump for a second term, U.S. interests not aligned with Europe. So some other stuff in terms of about geopolitical, something we've been talking about.
That is interesting, because normally a central banker, especially somebody else's central banker, wouldn't get involved in U.S. politics. And so it's kind of interesting. I'll let the people who write for Bloomberg Opinion expound on that, but it's kind of interesting that there is enough fear of Donald Trump that people would say that.
We hear it a lot, and I've heard it from top folks at some banks, not wanting to necessarily go on record or say who they are, but that is one of their biggest concerns about what that means. Hey, Yelena, forgive us as we went through some of the headlines. Talk to us about what jumped out for you in the inflation read. We also had weekly jobless today. And of course, Mike's great conversation with the Fed Cleveland Bank President Loretta Mester.
What really jumps out to us here is that there are a lot of impediments to a fast decline in inflation, and that is seen everywhere in pretty much every single major component of CPI. So whether it's core goods, we see that the declines in core goods were interrupted this month. It was because of used car prices. Yes, we do expect a little bit more room for disinflation here, but with what is happening in the Red Sea, the developments there that may push shipping prices higher, that may prevent further significant improvement on that front. In terms of shelter, housing has the activity in housing has picked up, and that may prevent a more significant decline decline in shelter prices, and of course, core services ex shelter. That depends a lot on what happens in the labor market, and the labor market remains, tight. We saw another low reading in jobless claims this morning. So the bottom line is that this data just adds to evidence that the Fed may not need to rush to cut rates. So we are expecting the first rate cut in May, not in March.
So on that, let's get to a little snippet of Mike's conversation with Fed Bank of Cleveland President Loretta Mester, who, as Mike said, this report didn't really change her mind, and she did weigh in on that March rate cut. Here's what she had to say.
I think March is probably too early in my estimation for a rate decline, because I think we need to see some more evidence. I think the December CPI report just shows there's more work to do, and that work is going to take restrictive monetary policy.
So, Mike, come on in. Your conversation, I was listening to it as I was working through and getting ready for our show. What was the most significant? Is it that what she said, or is there anything that you took
I think
away?
you would take the what she said about March as important enough, because she's a voter, and she's been hawkish, but I think she probably is reflecting what most people are thinking, because certainly that was what John Williams was saying yesterday. Mm-hmm. It's just too early, but I've been looking at the futures pricing for March, and after she spoke, it backed off a little bit, and then came right back again. And one of our eco team people in Washington sent me a message that says, when are the markets going to start listening? I have no idea.
10-year is just below 4%. It's been kind of like staying at 4%.
Yeah, well, the Fed
solidly.
really influences the two, and that went down. The yields went down on the 2-year today. But the 10-year is still up. Now, is that because of deficit issues? The government came out with a big deficit number today, and that could be influencing it, as well as the idea that inflation is going to take longer to go away.
So, Yelena, how many, come on back in here, Yelena Shulyatyeva. Given what we've learned in the past few weeks about higher for longer, which I would argue is not anything new, but it seems like the market is not necessarily paying attention to that, as Mike paraphrased one of our colleagues there. How many rate cuts do you have priced in for this year? And repeat again, once again, when you see them starting.
So we see them starting in May, and basically the Fed cutting it at every remaining meeting this year. But in terms of when the markets will start listening, I think we need to really get attuned to what the Fed officials are saying about the labor market. So Governor Waller is speaking next week, and that's probably going to be the highlight of next week in terms of the Fed speak. He was very early on talking about the beverage curve and how the labor market can normalize without seeing a significant increases in the unemployment rate. But will he start, if he starts talking about the labor market, that maybe, there are some risks to weaker developments there. So that could be a signal to the markets that the Fed is really attuned to both sides of their mandate, not just inflation, but they are also starting to look at what is happening in the real economy and in the labor market. Mm-hmm. And, Loretta Mester kind of hinted at that as well in Mike's interview. So that's when we're probably going to see some reaction.
She did talk, as I'm focusing on balancing the Fed balancing both sides of the mandate this year, right?
Yeah, well, they're concerned with making sure that unemployment doesn't skyrocket, while at the same time keeping the pressure on enough.
Hey, Mike, just in the last minute that we have with you, earnings kick off tomorrow. We hear from some of the biggest banks over the next few days. Is there anything that these CEOs or executives could say that would change the path of the Federal Reserve? Does the Fed pay attention to the commentary from CEOs like this?
Well, they do, but they're talking to them all the time, so it won't be new news to them. But basically, what we'll all be kind of watching for on the economic side is what the set-asides for bad loans are. How bad do the banks think that lending is going to be? So far, it hasn't been terrible. And then what kind of business they're seeing in credit cards and deposits. How are customers perceiving the economy these days? Are they depositing more money? Are their savings accounts going up, or are they borrowing more? The data we've seen from the Fed is they're borrowing more to spend.
Quickly, 10 seconds. Is there an economic data point or something that you're watching on that front? Next thing?
Well, we got that earlier this week, the credit numbers.
No, but I mean in terms of eco data in general.
Oh, well, we get PPI tomorrow and retail sales next week.
Okay.
So stay tuned.
Okay, I will. When I'm not watching the spot
After
Bitcoin
your
ETFs. It was a cold shower this morning. The hot water heater's not working. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Hey, here is something sobering. Every day, more than 120 people in the U.S. are killed with guns. Twice as many are shot and wounded, and countless others, Tim, are impacted by acts of gun violence.
I got some even more disturbing numbers for you. Since 2015, over 19,000 people have been shot and wounded or killed in mass shootings. In 2022 alone, over 600 people were killed, with over 2,700 wounded. Both the number of mass shooting incidents and the number of people shot in them have increased since 2015, reaching a high of 686 mass shooting incidents. Carol, that was just in 2021.
Yeah, we see them all the time, it feels like. It's a problem. It's an old one, and it's one watched by the Johns Hopkins Bloomberg School of Public Health. Their latest thoughts in a new report, Defending Democracy, Addressing the Dangers of Armed Insurrection. With more on it is Joshua Horwitz. He's co-director of the Center for Gun Violence Solutions at Hopkins, the Johns Hopkins Bloomberg School of Public Health. He's on Zoom from Baltimore. And a reminder that the school is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Mike Bloomberg, by the way, also a donor to groups that support gun control, including one that he helped launch, Every Town for Gun Safety. Joshua, nice to have you here with us. Again, the problem does not go away. Talk to us about the report, though, and how you guys wanted to look into it and research it, especially as we are, counting down to another presidential election here with a matchup between two candidates that have met up before.
Yeah, thanks for having me. I really appreciate you guys covering this topic. And as you mentioned, gun violence, in 2021 and 22 has certainly been on the rise. We have seen some reductions in 2023, but it's uneven and not across the board everywhere. So it's still a gigantic problem, a gigantic public health problem, which is one of the reasons that we're so passionate about this. But in this new report, there's been a lot of proliferation of firearms, especially assault weapons, AR-15s, a lot more open carry and concealed carry in this country. And not surprising, that's bleeding over into our politics, into our democratic process. And what we're trying to do in this report is to give policymakers and executives tools to make sure that the voting places are safe, that our legislatures are safe, and that our democracy is safeguarded from people who are trying to threaten that with firearms. So that's what this approach is about. We have a number of recommendations in this report, including limiting carry of open carry of firearms and concealed carry, making sure that we further regulate paramilitary activity, limiting firearms in polling places and legislatures, and making sure that we use all the tools at our disposal, that when we know someone's in danger, someone's threatening an elected official, threatening the democratic process, that we use some of these new extreme risk laws or red flag laws that states have passed to make sure that we prevent armed political violence.
I'm sorry, are we talking about the United States here?
We are talking about
because it doesn't sound like we are, I have to tell you. I cannot believe we're talking about this.
Tim mouthed to me while you were talking, right? I can't believe we're doing this.
This is not normal, Joshua, that we're talking about people being the concern about people being threatened by gun violence when they're exercising their democratic right to vote.
Look, I don't want to remind us that Gabby Giffords was obviously almost killed while exercising her right to meet with her constituents. We have seen armed political violence at state capitals. We've seen armed political violence in Charlottesville, the Unite the Right rally. And obviously, on January 6th, we saw a violent insurrection at the Capitol. Now, fortunately, DC actually has some good laws, the ones that some of the laws that we're recommending. But, in these other states, some of these other states don't have it. And there's been lots of incidents of voter intimidation. So we need to jealously guard our democracy. And you're right. It's hard to believe we're talking about the United States, but it is something that we must prepare for.
So in this research, you also have a stat, half of those surveyed, and it refers to, I guess, some of the research that was done, agreed at least somewhat that in the next few years there will be civil war in the United States. About 2% of the respondents in that same study thought violence was at least somewhat justified and to achieve a wide array of political objectives, reported being very or completely willing to kill someone to advance an important political objective. I mean, I'm not sure I understand how we got here. But I feel like in talking with our Josh Green, we have talked a lot about the political divisiveness and the rise of populism on both sides that maybe helped us here coming off of the financial crisis. Having said that, I feel like there's no will to kind of de-arm or unarm the United States.
Well, I think we got here, I think because we've really allowed a really ridiculous interpretation of the Second Amendment, where there's even elected officials talk about the individual right to fight government tyranny, and we have to combat that. The Second Amendment is about the individual right to serve in an armed militia under state control. It has nothing to do with individual rights to take up arms against the government. So I think that's number one. But number two, states are doing things about this. More states need to do that. But we've seen recently Virginia and Colorado take strong action to protect their legislatures, their polling places, and what we're getting across here is that we need to do that in every state. Because there's no reason people should be intimidated going to the polls. There's no reason that you should have to walk through an armed gauntlet to go lobby your legislature or get exercise your First Amendment rights. So we're out of balance here in the United States, and it's hurting our democracy.
Well, I just want to try to understand the argument for why people should take guns to these places. What have you heard in terms of pushback when you've tried to work with these legislatures in different states to enact rules about this? I mean, what do they say if they don't agree with you?
Well, I have a lot of experience in Virginia because I've spent 20 years working in that state capital, and for 18 of those, we had to contend with people who were armed within our hearing. When we were at a hearing, there were people who were armed in the hearing rooms. Through the halls of the legislature and in polling places. And, they make an argument, well, look, I have a right to carry a gun wherever I want to be safe. And my point is, well, you're in the state capitol, there are law enforcement all over the place. And what you're doing is really intimidating other people from exercising their votes and exercising their rights. So it's a mix between, I just want to exercise my right, which I don't buy at all. And the second thing is I need to have a firearm with me at all times for self-defense, which I don't buy either, especially in those locations. So I'm not sure it's a rational argument. I think it's a much more emotional argument. But again, we have elected officials in this country who are giving cover to that type of idea, right? I mean, during the inauguration in 2000, Ted Cruz wore a mask that said, "Come and take it." That's a militia slogan, right? That's what they often say in Latin, "Mulan labe," come and take it. So we have elected officials at the highest levels giving cover to this. And, in addition to all the things we need to do from a policy perspective, right, we must condemn this idea.
Joshua, I feel like folks who are listening or watching right now are like, yeah, we've been talking about this for a long time. They know that, something happens, we get a headline, everybody reads it and moves on, unless they are, impacted personally. What do you say to the public at large about this situation, which has been going on for years now, right? And as you say, some states are making progress, but what would you say to the public at large about this situation and maybe what needs to be done or how they should be thinking about it?
Number one, wake up. I mean, I wrote a book about this in 2009, warning people that this was going to happen. And people said, oh, no, that will never happen. And then we have an insurrection at the Capitol, right? And so what I'm asking, instead of just saying, oh, yeah, go to the next headline, this is an opportunity to talk to your state legislators, to talk to your policymakers, to make your voice heard and saying, I want the right to vote. I want the right to petition and talk to my legislators without the threat of armed insurrection. And we need to be able to articulate why this matters and what needs to get done. And I encourage people to read our report, Defending Democracy. It's on our website to give you all the tools you need to have a cogent argument about this. So if you're sick of it and you're sick of seeing it, and get off the couch, make your voice heard, read the report. All the tools are there to really be effective advocates in this space.
All right. We really appreciate your time and getting to discuss this subject. It's so important, and it is amazing. And like I said, not a new problem. It's an old one. So appreciate it. Joshua Horwitz, co-director of the Center for Gun Violence Solutions at the Johns Hopkins Bloomberg School of Public Health, on Zoom from Baltimore. Yeah, reminder, the Johns Hopkins Bloomberg School of Public Health, supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. And Mike Bloomberg is also a donor to groups that support gun control, including Everytown for Gun Safety.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
But one of the things that we've talked about for a long time is, and following the SEC approval of spot Bitcoin ETFs, is what it would do to the price of Bitcoin. Volatile trading. We've been looking at a lot of things. We've definitely seen a bit of a volatile trade today.
Yeah, we really have. So Bitcoin surged past 49,000 for the first time since December of 2021, trading commencing on the first US ETFs that invest directly in the biggest cryptocurrency, only to back off and go below 46,000. Right now, Carol, remember, this trade's 24/7.
Right.
Right now, Bitcoin's at 46,300, let's go ahead and say. So kind of a big swing today.
Right, exactly. All right. So a voice Bloomberg has often talked to about the trade overall and what's been going on in the crypto world is one of the 11 that got the SEC approval for its spot Bitcoin ETF. We're talking about Bitwise. Matt Hougan is back with us, Chief Investment Officer at the Crypto Index Fund Manager, Bitwise Asset Management, joining us on Zoom in New York. And Bitwise, it's a little
Bitcoin,
bit, yeah, I know.
Bitwise.
Their ETF down about 4.7%, but we did see a lot of pressure on most of these names. Matt, good to have you here. I've got to say, all of us have been burning the midnight oil this week because of you guys. Welcome back to Bloomberg. What can you tell us about the first day of trading, fund flows? What are you seeing?
Thank you so much for having me.
You got it.
It has been a very long and an exciting day. I think this has been a tremendous reception for Bitcoin ETFs after 10 years. Across the suite, you saw more than $4 billion in trading volume. Obviously, not all of that will translate into net inflows. And while we won't know the flows for a couple of hours, I can tell you here at Bitwise that we experienced significant demand on the buy side. Investors coming into Bitcoin, into our ETF, BITB, the lowest cost Bitcoin ETF to launch today. We saw substantial demand, and you'll see inflows in the hundreds of millions of dollars.
Okay, let's talk about these fees. What's the break-even level of assets that are needed for this fund to be profitable?
Yeah, these funds are relatively simple products at the end of the day. They take Bitcoin and hold it with a regulated third-party custodian. It's not like our other products where they're index funds and oversight and the same level of management. This do one very simple thing. So in constructing these products, what you do is you price them as low as you can to economically deliver it to clients, because the less they pay, the more they keep. Obviously, at 20 basis points for BITB, we're planning on this being a very large product. We think the market for these products is measured in the tens of billions of dollars or more. At those levels, it become very sound businesses. But we're pleased at Bitwise to have a broader business to build this on top of, and that helped us get to this aggressive price point.
Sorry, did you say the break-even level? I might have missed it.
Yeah, I didn't provide a break-even level specifically for this ETF, but
can you give me a range?
Look, I think these ETFs will be a success if they're $1 billion or more.
Okay.
Well, and, is this for retail or wealth advisors? What is your expectation about who is going to be ultimately the investor for this?
Yeah, I think a lot of investors go towards ETFs because they give them a great deal of peace of mind. They're not buying Bitcoin on an app or an offshore exchange. So I think there'll be some retail demand. But the real market here is financial advisors. Financial advisors have been wanting to access Bitcoin for a number of years. We know because we talk to them every day, and they want to do it through an ETF. And that's a really big market. That's a $30 trillion market, take your figure. But that's a new market that's been unlocked. That's the primary audience for these ETFs.
I'm guessing too, we've been talking about a lot, Matt, in terms of an advisor, they're going to say, why wouldn't you maybe just throw a small portion of your portfolio? Because as our Eric Balchunas said, earlier, what if all these guys are right in the crypto world and Bitcoin really does become something substantial longer term? So what kind of allocation do you think some of these advisors might be? Is it a fraction of a percentage? What is it? How small, and how small can it be and you guys still do very well?
Yeah, absolutely. That's a great question. I do think until the ETF, advisors could just say, I can't access it. They no longer have that excuse. They can access it in a regulated low-cost ETF like BITB. I suspect most advisors will be looking at a 1% to 5% allocation. And again, this is a very large market, and more people than just advisors can make that allocation. But if we see those kind of allocations become the norm, again, you'll be looking at this market being, tens and tens of billions of dollars. I've seen estimates up to $200 billion. So this is a very large market, even at those small allocation sizes.
So 1% to 5%, you guys are in it then for the long term, no problem.
Absolutely. We're in it for the long term. We've been in this market for 7 years. We expect to be in it for another 70. This ETF is a big part of that puzzle, and we're excited to get into the market.
A big part of the conversation that we've been having over the last few days over and over again is the question about utility when it comes to the actual Bitcoin as a currency. We know that stocks provide future cash flows. Some provide dividends to their shareholders. Fixed income, if you buy bonds from the government, they're backed by the full faith and credit of the US government. But Bitcoin exists as this different asset class. What's the case for utility here?
Yeah, there's a near-term case for utility and then a long-term case for utility. The near-term case for utility is a non-sovereign store of value like digital gold, a way to protect yourself and exist outside of the fiat system, which is subject to debasement and inflation. And that's driven Bitcoin's returns up to this point, and I think will continue to be the primary driver for a few more years. Long-term, the destination where Bitcoin is going is to be an alternative settlement rail for the world. The world may not always want to settle its primary transactions on politically controlled currencies. Before Bitcoin can offer that potential, it has to be much, much larger and much, much more liquid and much, much more established than it is today. That's why this ETF is actually important for Bitcoin, because it pushes us further on that journey. Are we there yet? Yeah. By no means. Could we be there by 2030 or 2035? That's Bitcoin's ultimate destination. We took a big step forward today.
Matt, yes or no? The first time there's a hack, is everybody going to run for the exits?
Oh, there's never been a hack of the core Bitcoin blockchain. One of the beautiful things here is these Bitcoin are held in regulated third-party custodians. So it provides that peace of mind. All
right. Good to check in with you. Matt Hougan, thank you so much at Bitwise Asset Management. This is Bloomberg.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, TikTok, everybody. Just got about 17 and a half minutes left in today's trading session. Bit of a volatile one, as we know. Dealing with some economic news, dealing with just kind of where we go next here.
Yeah.
In terms of Fed policy, the economy. Yeah.
And you know what?
What?
Looking through our next guest investments, thoughts and changes. Did you see anything on spot Bitcoin ETFs?
I did not.
Okay, that's okay. We got some fixed income. We got some equities. Let's get to our drive to the close with Sameer Samana, Senior Global Market Strategist at Wells Fargo Investment Institute, joining us on Zoom from Charlotte, North Carolina. Sameer, good to have you with us. I know you did not send us any thoughts on the new spot Bitcoin ETFs, but can we just start there? And because it's what everyone's talking about today and yesterday. Do you have any thoughts on this new asset class being available through ETFs?
Big picture, we've talked about how crypto and especially Bitcoin, have kind of matured over time and probably do have some, allocation within a well-diversified portfolio. And I guess, having it be a little bit easier to implement probably isn't a bad idea. I think that being said, this has been so well telegraphed and the price is, close to almost doubled over the past 6, to 8 months that, probably be a little bit cautious with respect to kind of timing and adding that allocation over time. But I think more broadly, I think it just speaks to how much momentum, positive sentiment there is in these markets right now.
Yeah, it is kind of interesting. I mean, are you fielding a lot of questions though, Sameer, about people like, hey, Sameer, how do you feel about this, new round of ETFs, if you will, spot Bitcoin ETFs? Like, should we have some exposure to them? Because as our Eric Balchunas said, like, what if these guys are right, that this becomes something significant in our world in terms of Bitcoin more broadly?
Yeah, I mean, thankfully, we've been talking about this for a few years now, and, there have been other ways to gain exposure to the asset class. So, hopefully, this is one of those things where at least, some of our clients have had a chance to kind of get exposure through those, other means. I think that being said, it is good to kind of maybe have that vehicle available going forward. But again, I think the tricky part is just, it's just so overdone right now that, people probably fall in one of two camps. Either they probably are kind of more on the savvier cutting edge and maybe have already figured out how to do it, or they probably don't fully understand what Bitcoin and crypto are, and they're probably going to be much more hesitant. So I get the sense that those who want to be in are probably in at this point.
Yeah, you make a really good point. Hey, I just want to get your take on, take a step back and just think about the global economy. We got inflation data that came in a little hotter than expected this morning. Surprising to me, Carol, that we didn't see more of a move when it came to yields, given that inflation data was a little hot. But as Mike McKee and Yelena Shulyatyeva
we
pointed
did pop like on the news a little bit.
But it didn't hold, right?
No, it did not hold.
Yeah,
we backed off.
And that was a little surprising to me. But like they said, things are moving in the right direction. Sameer, I mean, does it make you think differently at all about asset allocations or your outlook for global fixed income, given that, investors think, and they've priced in a series of rate cuts this year, and it seems like this last mile of inflation is going to be a bit tougher to get down?
Yeah, I mean, I think it'd be fair to say that at least the long end of the Treasury rates curve is probably priced for perfection. I mean, we literally just this week rolled out an alert, downgrading long-term fixed income from most favorable all the way back down to neutral. We've kind of gone, to that favorable positioning around 4.25 and kind of stuck with it throughout kind of that move up to 5% on the 10-year. And then this recent move lower just left us scratching our heads with respect to, again, to your point, that last mile inflation will be very difficult. Real rates as measured by current inflation relative to the 10-year is still pretty, net kind of low, right? You're not really getting compensated on that long end to take the risk if inflation is going to kind of get stuck in this 3 to 4% range, depending on which figure you're looking at. So from our standpoint, again, this is a great time to maybe park out in the short end, but we probably wouldn't be taking a lot of risk on the long-term end of the curve.
Yeah, it does make sense, right? We're getting much more clarity when it comes to expected monetary policy. We know it's tricky as we get near the end of this cycle for the Fed to get it exactly right and not overdo it. But it does feel like we have a lot more viewership, if you will, or view when it comes to the short term. Having said that, on the equity side of things, Sameer, I'm looking at the 11 major industry groups in the S&P 500 this year, and energy is the second worst performing. It's down about 2.5%. We've seen a lot of consolidation, a lot of deals happening in this space. You guys are upgrading the energy sector from neutral to favorable. Let's start there. How come?
Yeah, so that same alert, we upgraded energy and we downgraded financials. Happy to speak to both. On the energy front, I mean, look, if the market's going to run on soft landing, right? If the Fed has somehow engineered this, which maybe we're a little skeptical, but let's say they actually have engineered this. Well, in that scenario, I can't imagine oil sticks in the low 70s, which is pretty much where it is right now. I can't imagine that you don't have at least some additional profitability on the energy equity side. And so this soft landing narrative has pretty much left energy energy kind of by the wayside. And honestly, if there is a little bit of an economic, stumble, we think that, energy prices and crude prices probably already reflect, what could be kind of a mild to moderate recession anyway. So, for all those different reasons, we saw probably as close to a free lunch based on valuations, based on this narrative that's kind of taken hold and just the relative performance.
Why are you skeptical that the Fed can pull off a soft landing?
Just because it takes, so much in terms of being able to judge the lags. I think there's a lot that, we're seeing right now with respect to the consumer hitting in their pocket. I just read a headline today on Bloomberg talking about how delinquencies are rising on credit cards. So, when you take all those different things into account, and the fact that, a lot of people, for whatever reason, either they're not selling their homes or they're not moving or they're not taking out new loans, have been able to avoid those higher interest rates. The problem is eventually you will have to buy a new car, buy a new home, move, all those different things. And when you do, there's a pretty good chance you're going to be paying a rate that's maybe 2 to 3x what you last paid.
All right, going to leave it on that note. Hey, Sameer, thank you so much. Sameer Samana, Senior Global Market Strategist at Wells Fargo Investment Institute, on Zoom from Charlotte, North Carolina. You mentioned those credit card delinquency. The rates have exceeded pre-pandemic levels, while the share of borrowers making only the minimum payment climbed above 10% for the first time since 2019. This is according to a Federal Reserve Bank of Philadelphia report. So, yeah, that can be very troubling.
That's why we're going to wait to hear from the big banks, including Bank of America, tomorrow about what they're seeing when it comes to loan loss provisions and charge-offs from credit cards.
Yeah, it's a big one.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.